September 2008, a 158-year-old bank collapsed overnight. $600 billion gone. Retirement accounts vanished. Millions lost their job. But what if the real cause started with a lie so simple you could fit it on a billboard? Why rent when you can own? It's 2002. America is still nursing a hangover from the dot-com crash, and recent shocks have hit the economy hard, making Wall Street nervous. But the solution is to slash interest rate basically zero. Money's cheap, borrowing is easy, and suddenly everyone's new favorite pastime isn't baseball anymore, it's buying a house. Congratulations, you're approved for $500,000, but we make $40,000 a year. Not a problem. Adjustable rate, balloon payment, special loans with no income, no job, no assets required, no problem. Back in the early 2000s, home ownership wasn't just a roof and four walls. It was the dream, stability, status, suburban bliss, and the message everywhere: why rent when you can own? Banks pushed even harder. They started throwing money at people like it was a game show, and everyone was winning. Enter the subprime mortgage, loans for people with bad credit, unstable income, or almost no money knowledge. No matter your situation, you could qualify for a luxury place. Should you be worried about paying it back? Not really. If you default, the bank just resells the house at a profit. It was a housing gold rush, an all-out frenzy. Prices skyrocketed. Your neighbor's house doubled in value in months. Even part-timers and those with almost no savings could get approved. Rules vanished. Traditional lending standards went out the window, and down payments became optional. If you had a pulse, you had a mortgage. People bought houses like instant noodles, and lenders printed loans like monopoly money. Mortgage brokers earned commissions faster than you could say the word bubble. Underneath all this excitement, there was one blind faith: that housing prices would always go up, because they always had until now. But beneath the open houses and shining countertop, a question lingered. What could possibly go wrong? Spoiler: everything. But this was just the beginning. By 2005, buying a house wasn't about stability. It was about flipping for profit. Real estate wasn't shelter. It was a lottery ticket. People bragged about owning multiple homes they didn't even live in, buying and flipping over and over, and prices soared as more people rushed in. It was like putting out a fire by throwing gasoline at it. But beneath this frenzy, those subprime mortgages were actually bad. High risk, lightly checked, barely verified debt. Yet Wall Street had its own magic trick. They bundled all that risk together, slapped a safe-sounding label on it, and sold it as a safe investment: mortgage-backed securities. How do you make risky loans look good? Get rating agencies to call them AAA. Here's the untold part: the rating agencies were getting paid by the same people whose product they were rating. Imagine hiring a food critic on the condition they call your raw chicken 5-star quality. Behind the scenes, everyone knew many of these bundles were junk. But Wall Street wasn't done. They took those shaky bundles and reblended them into even more complicated product: new debt obligation. Through financial alchemy, weak loans became investment-grade assets. A few savvy people saw the danger and decided to bet against the system. The problem? There wasn't even a product to do that. Yet, that's when new insurance contracts were created. Pay a monthly fee, and if the housing market collapsed, you got major payout. Everyone wanted in, so contracts multiplied. Bets stacked higher and higher on top of already weak blocks. The entire financial system became a Jenga tower of risk. Every block a bad mortgage, every layer a bigger, riskier bet. At the top, huge bonuses, easy money, but ignored warnings. Regulators looked the other way. Greed ruled. At first, it was just a whisper: a missed mortgage here, an empty house there. But then came a wave. Headlines screamed home prices were actually falling. What's supposed not to have happened, happened. In 2007, someone pulled the wrong block. Those risky deals started to implode, and the complex investments built out of them began to detonate. Suddenly, supposedly safe assets became toxic. Panic spread. Hedge funds bled. Investment banks slashed billions in losses. Then chaos. A major bank collapsed. No bailout, no hero, just a massive crater in the heart of finance. The message was clear: if it could happen here, it could happen anywhere. Banks stopped lending to each other. Global credit froze. Everything halted. Families couldn't get loans. Businesses missed payroll. Investors lost fortunes, and pensions vaporized. By late 2008, it was a full collapse. Millions unemployed. Foreclosures everywhere. Eviction notices stacking up, and lines at soup kitchens and unemployment offices growing into desperate crowds. This wasn't just finance. This was real life, and the pain spread worldwide. Banks toppled in other countries. Markets crashed. Economies spiraled. The question was no longer who's next, but is the whole system broken? The Great Recession began. The government faced a choice: let everything go or pull pour in billions to try to stop the devastation. A rescue package was rushed through, throwing money at the system to keep it from breaking completely. Aid went out to failing businesses and institutions everywhere, in every form possible. Central banks pumped money into the markets to keep things moving. Markets eventually calmed, but Main Street still suffered. Unemployment soared, homes were lost, and family wealth vanished overnight. The people who caused the mess walked away fine, while millions paid the price. Trust in the system was burned to the ground. In the aftermath, a new generation saw the hard truth. When the powerful break the rules, they get saved. When ordinary people stumble, they pay. And the next crisis? It never looks exactly like the last, but that makes it even harder to spot before it's too late.